The Federal Reserve System is one of the most powerful entities in the financial world. As the central bank of the United States, it plays a crucial role in the country's economic growth and stability. However, the Federal Reserve's actions and decisions can also impact the stock market, and thus, investors must understand how it works. In this video, we will explain what the Federal Reserve is and how it impacts the stock market. We will provide essential information that beginner investors need to know to make informed decisions. I am not a financial advisor. These videos are for educational purposes only. Investing of any kind involves risk. While it is possible to minimize risk, your investments are solely your responsibility. It is imperative that you conduct your own research. I am merely sharing my opinion with no guarantee of gains or losses on investments. 8 important points to be covered in the video. 1. What is the Federal Reserve System? 2. How does the Federal Reserve impact the economy? 3. The Federal Open Market Committee, FOMC, and its role in monetary policy. 4. Interest rates and their impact on the stock market. 5. Quantitative easing and its effects on the economy and stock market. 6. The relationship between inflation and the Federal Reserve. 7. The impact of the Federal Reserve's decisions on international markets. 8. How investors can track the Federal Reserve's activities and use this information to inform their investment decisions. Let's get to the first question. What is the Federal Reserve System? The Federal Reserve System, also known as the Fed, is the central banking system of the United States. It was established in 1913 to stabilize the country's financial system and regulate monetary policy. The Fed consists of 12 regional banks, a board of governors, and the Federal Open Market Committee, FOMC, which is responsible for implementing monetary policy. The main functions of the Fed include supervising and regulating banks, controlling the money supply and interest rates, and conducting economic research. It is important for beginners to understand the Fed's role in the economy and its impact on the stock market. The Fed's interest rate and monetary policy decisions can significantly affect stock market performance, and investors need to be aware of these factors when making investment decisions. It's also important to understand the structure of the Federal Reserve System and how its various components work together to achieve its goals. By understanding the fundamentals of the Fed, investors can better navigate the stock market and make informed investment decisions. Before we continue, I would be very happy if you would support Your Money Internet channel by subscribing to our channel and liking the video. Now on to the second question. How does the Federal Reserve impact the economy? The Federal Reserve plays a significant role in the U.S. economy as it impacts everything from interest rates to employment levels. The central bank sets monetary policy in order to maintain a stable economy and a healthy financial system. Through various tools and mechanisms, the Fed can influence borrowing and spending habits of individuals and businesses, control inflation, and even stabilize the stock market during times of volatility. One way the Federal Reserve impacts the economy is through setting interest rates. The Fed can increase or decrease rates to encourage or discourage borrowing and spending, which can affect the overall growth of the economy. Additionally, the Fed can use open market operations to buy or sell government securities, which can also impact interest rates and money supply. The Federal Reserve can also impact the employment level in the economy. When the economy is in a recession, the Fed can use expansionary monetary policy to encourage economic growth and create jobs. Conversely, the Fed can use contractionary monetary policy during times of inflation to slow down economic growth and prevent the economy from overheating. Overall, the Federal Reserve has a significant impact on the U.S. economy, and its decisions can have far-reaching consequences for businesses and individuals alike. Understanding how the Fed operates and its effects on the economy is crucial for investors and anyone interested in the financial markets. The third question is about the Federal Open Market Committee, FOMC, and its role in monetary policy. The Federal Open Market Committee, FOMC, is a group of 12 members that meet 8 times a year to determine the nation's monetary policy. The committee includes the 7 members of the Board of Governors of the Federal Reserve System and 5 of the 12 Federal Reserve Bank presidents. The FOMC is responsible for setting monetary policy by directing open market operations, which involves buying and selling government securities in the open market. This is done to control the money supply and influence interest rates. The FOMC's main goal is to achieve maximum employment, stable prices, and moderate long-term interest rates. To do this, the committee sets a target for the federal funds rate, which is the interest rate at which depository institutions lend and borrow overnight funds to maintain their reserve balance at the Federal Reserve. The FOMC uses open market operations to influence the federal funds rate, which in turn affects other interest rates in the economy, such as those for mortgages and loans. Understanding the role of the FOMC in monetary policy is crucial for investors to make informed decisions about their investments. By keeping a close eye on the FOMC's actions and decisions, investors can better predict how the stock market and economy will be affected. Now we come to the fourth point: interest rates and their impact on the stock market. Interest rates play a crucial role in the economy and the stock market, and the Federal Reserve has a significant impact on them. The Federal Reserve has the power to set the interest rates that banks charge each other for overnight loans, which can influence the overall interest rates in the economy. Changes in interest rates can have a significant impact on borrowing and spending, and in turn, on the stock market. When interest rates rise, borrowing becomes more expensive, which can lead to less spending by consumers and businesses. This can lead to a slowdown in economic growth, which can negatively affect the stock market. On the other hand, when interest rates are low, borrowing becomes cheaper, which can stimulate spending and economic growth, leading to a positive impact on the stock market. The Federal Reserve can also use interest rates to control inflation, which is another factor that can impact the stock market. By increasing interest rates, the Fed can help slow down inflation, which can be beneficial for the economy and the stock market in the long run. Overall, understanding the role of interest rates in the economy and the stock market is important for investors. Keeping track of the Federal Reserve's decisions and announcements can help investors make informed decisions about their investments. Now for the fifth point: quantitative easing and its impact on the economy and the stock market. Quantitative easing is a monetary policy implemented by the Federal Reserve to stimulate the economy. In essence, the Federal Reserve buys assets such as government bonds, mortgage-backed securities, and corporate bonds from financial institutions to increase the money supply in the economy. The idea behind this is to encourage borrowing and investing, which ultimately leads to increased spending and economic growth. The effects of quantitative easing on the stock market are twofold. Firstly, the increased money supply leads to lower interest rates, making borrowing cheaper and more attractive for companies looking to invest in growth. This can lead to increased profits, which can in turn lead to higher stock prices. Secondly, quantitative easing can also lead to inflation, which can have a negative effect on the stock market. As the value of the dollar decreases, investors may look to move their money out of stocks and into other assets such as commodities or foreign currencies. It's important to note that the effects of quantitative easing on the stock market are not immediate and can take time to materialize. Additionally, there are potential risks associated with this policy, such as an increase in debt levels and potential for asset bubbles. Overall, understanding quantitative easing and its effects on the economy and stock market is crucial for investors looking to make informed decisions. The sixth point is about the relationship between inflation and the Federal Reserve. The relationship between inflation and the Federal Reserve is a crucial one in the world of finance and economics. Inflation is the general increase in prices of goods and services in an economy over a period of time, and it can have significant impacts on the overall health of the economy. The Federal Reserve plays a key role in managing inflation through its monetary policy decisions. The Fed has a dual mandate of maintaining maximum employment and price stability. To achieve this, it sets a target inflation rate of 2% per year. When inflation is too high, the Fed may raise interest rates to slow down economic growth and cool off prices. Conversely, when inflation is too low, the Fed may lower interest rates to stimulate economic activity and increase prices. It's important to note that inflation can have both positive and negative impacts on the stock market. On one hand, moderate inflation can signal a healthy economy with strong consumer demand and corporate earnings growth. On the other hand, high inflation can lead to higher interest rates, which can dampen economic growth and decrease corporate profits, leading to a decline in stock prices. Overall, understanding the relationship between inflation and the Federal Reserve is essential for investors to make informed decisions in the stock market. The seventh point is about the impact of Federal Reserve decisions on international markets. The Federal Reserve's decisions and policies not only impact the U.S. economy and stock market, but also have a significant effect on international markets. When the Federal Reserve raises interest rates, it attracts more foreign investment, which can lead to an increase in the value of the U.S. dollar. This, in turn, can make exports more expensive and less attractive to foreign buyers, potentially harming U.S. businesses that rely on international trade. On the other hand, when the Federal Reserve lowers interest rates, it can stimulate economic growth and increase investment, which may benefit international markets as well. The Federal Reserve's policies can also have a ripple effect on emerging market economies, particularly those with high levels of foreign debt. When the U.S. dollar strengthens, it can become more expensive for emerging market countries to repay their debt denominated in U.S. dollars. This can lead to currency devaluation and economic instability in these countries, which can ultimately impact the global economy. It is important for investors to be aware of these potential international impacts of the Federal Reserve's decisions, as they can have significant implications for global markets and individual investment portfolios. Understanding the interplay between the Federal Reserve, the U.S. economy, and international markets is crucial for making informed investment decisions in today's interconnected global economy. Now we come to the final point: how investors can track Federal Reserve activity and use that information to inform their investment decisions. Investors need to keep up with the latest developments in the economy and the financial markets to make informed decisions. The Federal Reserve plays a crucial role in the U.S. economy and has a significant impact on the stock market. In this video, we have discussed the basics of the Federal Reserve and how it impacts the stock market. We have covered topics such as the Federal Reserve System, its role in the economy, the FOMC, and monetary policy, interest rates and their impact on the stock market, quantitative easing, inflation, the Fed's impact on international markets, and how investors can track the Federal Reserve's activities. By understanding these topics, investors can make better informed decisions and adjust their portfolios based on the current economic and market conditions. In conclusion, the Federal Reserve is an essential player in the economy and has a significant impact on the stock market. As investors, we must understand its policies, actions, and their implications on the financial markets to make sound investment decisions. We hope this video has helped you understand the basics of the Federal Reserve and how it impacts the stock market. Thank you for watching, and we'll see you in the next video.